Hi there, VandenBerg Fund Manager for TaliMar Income Fund. One question I'm getting a lot of from investors is regarding the 10-year Treasury and the recent spike in the 10-year Treasury and how that could impact the return and the risk profile of the fund. So I wanted to take a quick moment and explain what is the 10-year Treasury and how it could impact the fund directly and indirectly. So what is the 10-year Treasury? Well, the 10-year Treasury is essentially the interest rate the U.S. government pays to borrow money for a period of 10 years. It's actually considered one of the most important benchmark rates in the financial markets because a lot of other interest rates are tied to it, especially mortgage rates, and they tend to move in relation to the 10-year Treasury. So when you hear that mortgage rates are rising or falling, a lot of that movement is tied to what's happening within the 10-year Treasury. Now, why does the 10-year Treasury move? There are a lot of factors, in fact, including inflation expectations, government spending, economic growth, Federal Reserve policy, and global uncertainty can all impact Treasury yields, especially for investors who are constantly evaluating risk in future inflation. The Treasury rates are going to move based upon their expectations. So this year, the 10-year Treasury bottomed out about 3.96% and then quickly spiked up to about 4.66%, settling back to about 4.5% as of today. Now, a lot of this volatility has been tied to Iran and the potential impact on oil prices and inflation. Whenever energy prices spike, markets tend to worry about inflation, which could push Treasury yields higher. Now, one important thing to understand is that the 10-year Treasury does not directly impact the fund. Our fund is not bound by what the 10-year Treasury price is at any given moment. However, the 10-year Treasury really does act as a barometer for the broader economy and the lending environment, and that's how it can indirectly impact the fund. So for example, when the 10-year Treasury rises, mortgage rates usually rise as well, as I had mentioned earlier. That means that borrowing money becomes more expensive for homeowners and real estate investors. For some of our borrower clients who are flipping homes, higher mortgage rates can impact the affordability for the end buyer of the home they're selling. In simple terms, if the monthly payment becomes more expensive, buyers may not be willing or able to pay the same price for a property. For borrowers who are planning to refinance our loan, higher rates can also make their long-term financing more expensive and reduce the chances of their ability to get long-term financing. So while the Treasury doesn't directly change our returns, it absolutely influences the overall real estate and lending market in which we operate in. Now, when it comes to actual returns of the fund, the biggest driver is really interest rates, or is really the interest rate that we can charge on our loans. And that comes more down to the supply and demand of the capital that we deploy. The more capital that enters the market, the more aggressively lenders are competing on the same price, and that pushes pricing down. The less capital available in the market, the more flexibility lenders like us have to maintain or increase our rates. And what determines how much capital enters the market? Well, the biggest risk, or the biggest factor, is the perceived risk of the general economy. Think back to COVID or when the Federal Reserve first started rapidly increasing interest rates. During those periods, there was a lot of uncertainty around property values in the general economy. And because of that, many lenders and capital providers pulled back, which reduced competition and allowed private lenders like us to be more flexible in our pricing. However, more recently, the market has generally become more comfortable with current property values and overall economic conditions. That confidence has brought more capital back into the market, which naturally creates downward pressure on loan rates. So that said, over the last couple of weeks, you could probably argue that rate compression has slowed and rates have actually moved slightly higher due to the renewed concerns around the increase in the 10-year Treasury. Personally, I think the 10-year Treasury will likely continue trending lower as markets become more comfortable with the situation involving Iran, as well as inflation concerns tied to oil prices. Historically, markets tend to adapt fairly quickly by finding alternative energy sources and stabilizing supply chains. But at the moment, I actually think we're in a pretty healthy environment overall. There's a good balance between deal flow, and available capital, which is helping create a floor for loan pricing. So hopefully this gives you a little better understanding of how all of these pieces connect. There are a lot of moving parts that impact investor returns, obviously treasury yields, inflation, global events, real estate values, capital availability, and borrower demand. Now, our focus continues to be on managing risk carefully, maintaining strong loan quality, and identifying lending opportunities that we believe offer attractive risk-adjusted returns for investors over the long term. Now, if you found this video helpful, please consider giving it a like. Definitely subscribe to our YouTube channel. We post a lot of content about the private lending industry. We do site visits, we do interviews. We post a lot of content on our channel. So please take a look, give it a like, and thanks for watching.